if you're thinking about a partial buyout, so less than 100%, the SBA made a new ruling that in the scenario of partial buyouts, the seller is going to have to personally guarantee your SBA loan for 2 years. Now, all these changes are only for those seeking SBA loans. Specifically, SBA 7A loans are the ones we typically will use to acquire these small businesses. Other areas of changes were in the case of partial buyouts, the 20% rule, which for those of you who don't know, if an investor owns less than 20% or up to 20%, they didn't have to personally guarantee it, though that's no longer the case if in a partial buyout. Another key change was the SBA made a ruling that buyers must now contribute 10% of the total equity as their down payment. Before, there used to be ways to lessen that. The only workaround now is buyers must contribute 10% of the total project cost in equity. Seller notes are no longer eligible to count towards that 10% down payment. So going forward, for example, in a $2 million deal, it now requires $200,000 in buyer equity in the form of your own cash or investors' funds. If you want to use a seller note to make up some of that equity, it is now a full 10-year standby before those payments can begin. Prior to this ruling, it typically was a 2-year standby when the seller note payments would start to begin following those 2 years. Now, some of you may get confused about this. This is only the case where you as a buyer can't meet that equity minimum payment and you want to use a seller note to cover some of that buyer equity threshold. Seller notes, if you as a buyer can meet that minimum equity of 10% down payment, the seller notes can function as normal. So there's not a ton of changes. If you have further questions about it, I'd be happy to answer them. So where in the due diligence process is a letter of intent applicable? Like, where does it come up? So I highlighted the initial discussions because if you're a business searcher and you're actively searching for businesses, you likely are in this initial discussion bucket. You're having conversations with sellers, brokers, and you're actively reviewing deals. Once you do find a business where you're excited about it and it seems like a good fit, you transition into what is known as, the letter of intent phase, where both parties will agree to the basic terms of the deal and then add in, a non-binding document called the letter of intent or LOI to basically kick off your exclusivity period. The exclusivity period will cover your due diligence and purchase agreement time period. Due diligence is going to include, the bank underwriting, financial due diligence, legal due diligence, operational due diligence. So that's kind of how that process works and where it falls in the full transaction itself. I'm going to have a quick polling question to see who's in the audience today. Where are you in your business search process? Are you under LOI, actively searching, or new to search? If you don't mind answering quickly, that would be much appreciated. Give you about another 10 seconds. So it looks like about half of you are actively searching, and then just started searching, with the other half. For those actively searching and just started searching, all of these kind of topics are great things to think about. I would encourage all of you to understand the new SBA rules, which are effective 6/1/25, because every deal you are actively pursuing is going to have to take into consideration some of these small changes. Again, if you have questions, happy to answer them, maybe at the end of the webinar, or feel free to message me offline. So when we think about the letter of intent, I always like to start out with, the timeline in general. So when we sign the letter of intent, it's basically a binding agreement between buyer and seller, over loose terms of the transaction, the purchase price, how long is it going to take, is there an exclusivity period, what is the expectations of buyers and sellers, and from there, it basically starts your formal due diligence period. You'll see on the top, the signed LOI basically begins the clock of, depending on the number of days you stipulate in your letter of intent, it's typically anywhere from 30, 60, 90, 120 days. You will formulate your due diligence team and start conducting your thorough analysis. Best practice is to curate a letter of intent with at least a 60 to 90 day time period. And the reason you want to do that is very simply, there's a lot of different components of diligence you need to do. And there are many parties involved in this process. For example, financial due diligence is conducted by a quality of earnings team. You're going to have some form of an SBA or bank underwriting process. You likely will conduct tax compliance and operational due diligence, whether that's going to be performed by the Q&A team or another third party. Lastly, you're going to likely conduct some form of legal due diligence, which is conducted by an M&A team, an M&A attorney. Their primary focus is going to be drafting the purchase agreement and making sure all of your deal terms in your letter of intent make it to the binding purchase agreement. So there's a lot that goes on during your due diligence period. So rule of thumb, which I like to show the timeline, is give yourself more time than less, because often rushing due diligence is a quick way to miss a material deal item. And once you sign that purchase agreement, it is fully binding. So you're much better off taking your time and thoughtfully curating a letter of intent, which makes sense for both buyer and seller. So what are some of the key components of an effective letter of intent or LOI? You want to identify the parties involved, buyer, seller, often the entities, the company name, if you have a LLC or another company name you're operating under when you're conducting your search. You're going to describe the transaction. Is it going to be like, what kind of transaction is it going to be? It's typically either going to be a stock or an asset sale. What does the purchase price and the structure look like? Purchase price being, what is the total amount of cash at closing? What does the total enterprise value look like? If there's a seller note component, what does that look like? Number 4 is due diligence. So is there going to be due diligence conducted during the letter of intent period? Is that going to be conducted by yourself? Is it going to be a third-party due diligence provider? That's going to be your 4th component. And oftentimes in that 4th, 5th, and 6th component, there are conditions that you'll layer into your letter of intent. Things like it is assumed that the seller will cooperate with the due diligence team and provide full transparency into the company records. If there are, there might be other conditions stating if the seller is unwilling to cooperate, it allows you room to move on from the transaction and walk away. And really, it just sets the stage for a productive and fruitful due diligence period, because without cooperation and full transparency on both sides of the table, these deals likely won't get closed. It'll add in things such as exclusivity. So I think number 5 is the most important piece of the letter of intent. And the reality of it is you as a buyer need to ensure that you are given exclusivity, in your letter of intent for X number of days. That means that once you formally agree to offer a purchase price, you as a buyer get exclusive rights to that business, and it cannot be solicited for other parties to submit LOIs. This is often something I see try to be excluded from some business brokers who like to shop around their deals even when parties are conducting due diligence. So please make sure you are being granted that exclusivity period. And the reason is you're going to spend a significant amount of time and money hiring third-party Q&A teams, M&A attorneys, etc. You need to make sure that that money and time is spent wisely and you're granted exclusivity, because it's significantly expensive to hire these third parties, and you would hate for the deal to be given away and shopped to another party while you were conducting due diligence. Believe it or not, I've seen this happen frequently in the cases where exclusivity was not granted. So this is the sticking point that I recommend has to be in any formal LOI that you sign. Termination clauses, those termination and conditions, they're going to outline some loose terms of instances where you're allowed to walk away from the deal. If the business earnings are not what they say they are after due diligence is conducted, that is often a termination clause I'll see. If you're unable to acquire a bank loan, that's often a termination clause I'll see. Conditions, for these SBA type loans, you're under the control of the bank. If you're unable to obtain a bank loan, you effectively cannot purchase this business. So that's often a condition or termination clause I'll see layered in. So taking a step back and zooming out, what is, this letter of intent? It's typically a non-binding agreement outlining the key terms of a potential acquisition. It sets the negotiation framework and guides this due diligence process. Key terms include the price, the terms of the agreement. Is it going, how is this purchase price of, let's say, $5 million going to be paid? Is it going to be paid with cash, a seller note, outside investors? Like, what do those components look like? Are there going to be a timeline of what does due diligence look like? Think 60, 30, 60, or 90 days. And then what are other contingencies For example, verification of earnings following due diligence. Verifying EBITDA is $1 million as stated in the marketing materials you submitted a bid on. Is that verified and confirmed in due diligence? If it's not, there may be a condition or contingency that allows you to renegotiate your original offer. These are some of the components of what is this LOI. So what effective elements all LOIs need to include? You must include key things such as the purchase price, the payment method, and the deal structure as outlined. Deal structure being, is it going to be an asset or a stock sale? Is it going to be a combination of cash at closing and a seller note? Is there not going to be a seller note involved? These are things you need to clearly lay out during this LOI stage. Important exclusions. You want to avoid overly restrictive clauses to allow yourself a little bit of flexibility. When you're submitting a letter of intent, you don't have all of the information. You're likely only given limited information in marketing materials. So you need to set the expectations that this is subject to change, given I don't have all of the pieces to the puzzle yet. Once I do, following due diligence, I can clearly articulate if what was in the letter of intent makes sense and can be funded by a bank and supported by a bank loan. And just making it as clear as possible. Clear language and simplicity in these letter of intents often is the best practice. If you use vague or confusing language and verbiage, a seller is likely not going to understand it fully. And this could cause issues during diligence and at the time of purchase agreement. For example, I've seen many times where working capital is not clearly laid out during in the letter of intent. And it is assumed by the buyer often that the seller will deliver some form of working capital at the time of closing. I've seen several instances where sellers don't understand exactly what that means. And they might be under the assumption that they're not going to deliver any working capital at close. Unfortunately, situations like this are a very easy way for these deals to die because things like working capital, seller notes, exclusivity periods, they can materially impact a deal if they're not clearly laid out in the LOI. So rule of thumb and best practice is put in clear language, communicate effectively, and make sure you as a buyer are communicating to the seller what is in this letter of intent, why it matters to them, and just double checking they understand the mechanics of how this works and the dollars at stake. So some key terms to protect your interest. Oftentimes in LOIs, I will see things like purchase price adjustment mechanisms. It'll include provisions such as working capital. Oftentimes, I will see the verbiage like working capital will be delivered. A normalized level of working capital will be delivered at the time of closing. Following, once working capital is pegged or calculated by the due diligence team, there will be a 30 or 60-day look back period, and the purchase price will be adjusted upward or downward accordingly. That's a very nuanced piece of letter of intents and purchase agreements. If you have questions about that, I'm happy to share some materials about how that works later on. Other ways you can protect yourself is indemnification and reps and warranties. The reps and warranties is going to be the representations the seller gives about the business, how the financials are, they're materially in line, they haven't been manipulated. Those are going to be some reps and warranties, which can clearly protect your position to the extent possible during that purchase agreement time. Work with an M&A attorney through the indemnification and reps and warranties bit, because they will be better suited to articulate best practices. So some common pitfalls in letter of intents I've seen throughout the years are overly aggressive terms. You as a buyer need to be flexible. If you are very aggressive with purchase price and terms during the letter of intent, it might threaten your letter of intent being accepted. Whether that's a good thing or a bad thing, that's up to you to decide. Before you compile your letter of intent, I would have a conversation with the seller about what terms work for them and then plan accordingly. If you just submit letter of intents based on exactly what terms you're looking for, it might work eventually, but I would avoid having a perfect, buy box of what your letter of intent must include in order to get some of these letter of intents actually signed. Vague language is a common pitfall. I spoke on a little bit earlier about the working capital item. If there are other things such as exclusivity period, the seller transition period, those need to be hashed out clearly before this LOI is signed. And the reason is, if you don't do this, you're risking the time, money spent during due diligence for broken deals. Again, vague language around working capital, seller transition period, the structure of the deal. These are all components that materially can impact your deal if they're subject to change during purchase agreement time. If you're actively searching for businesses, these are the key components which really move the needle and help you avoid broken deal costs. So it's in your best interest to make sure this language is clear. So I encourage all of you to work with someone experienced in LOI negotiation and structuring to make sure you avoid this ambiguity and language issue. Quick pause. So if you want to attend some of the other events I'm holding for webinars, feel free to scan some of those QR codes. Working capital is always an important topic. We're going to be speaking about that on April 30th. More S&B deal structuring and financing is coming up as well at the end of May, and then into June, we're going to be speaking to a few owners and operators about the first 100 days, how to succeed after business acquisition. That one's going to be super exciting, speaking with a couple great entrepreneurs about what works for them and what doesn't. Feel free to scan the QR codes or check out my LinkedIn to sign up for more. Um, so for the exclusivity, the critical LOI provisions, and we kind of touched upon this, they're going to be, what does the exclusivity period look like? Is it going to be 30, 60, or 90 days? What are some of the other enforceable language you can include to make sure that the seller or the seller's team, acknowledges and allows you the time and space to conduct thorough due diligence? Again, communication is often best practice for making sure you're granted this exclusivity period. Rule of thumb, as mentioned, is 60 to 90 days. Termination rights, again, these can include things like if there are material changes in your ability to get a bank loan, if there are changes in the financial data as originally presented, you have the right to terminate the agreement and basically end your discussions with this prospective business. Breakup fees. So this one is discussed about a lot, so that's why I wanted to include it here. I have seen some discussion on LinkedIn and other channels about buyers including some sort of fee for sellers to pay in the event the seller walks away from the transaction. My 2 cents are, more often than not, sellers won't agree to this, and you actually may lose out on a good business because they don't want the risk of being subject to a breakup fee. I have seen instances where breakup fees are included, but in reality, if the seller walked away, a buyer would need to spend a significant amount of money in order to actually even try to recoup that fee. So my best practice is to leave out breakup fees for if you are a buyer submitting these letter of intents. I think it does more harm than good. But again, work with an attorney and understand what's best for you. So let's take a step back, and we're thinking about submitting a letter of intent, and we're trying to conduct preliminary due diligence. So what does that look like? This at a high level is 3 components. It's 1, a financial review. This is going to be scrutinizing and understanding what are the revenues of the company? What's the profitability? What is the cash flow? You're going to be doing some form of legal review, investigating contracts, understanding if there's potential litigation, compliance issues. And then you're going to understand operational reviews, assessing key customers, suppliers, and assets if they're applicable to the business. Another component often valued in preliminary due diligence is understanding what are the seller goals. Why is the seller trying to sell their asset? How did the business start? I often recommend keeping it very simple in preliminary discussions with the seller, understanding at a high level why they're selling the business. What are they looking to get out of the transaction? Do they have something in mind? What kind of transition support are they willing to offer? These are all things that are very important for you to understand before you spend a bunch of time and money in due diligence if this is a good fit. So what are some of the key metrics to scrutinize during financial due diligence? A lot of it is revenue recognition, understanding the consistency and sustainability of earnings, and then walking through some of the key performance indicators or KPIs. Identifying trends in the business. Is the business performing well overall? Has it started to decline? Are there changes in the expenses and profitability of the company? These are all good things you can learn from the limited information you're granted before you do submit a letter of intent. When you do move into formal financial due diligence, working with a third-party quality of earnings provider is often best practice. A trained M&A CPA can heavily scrutinize the financial statements and really give you comfort in verifying that the earnings as presented are real and what you can expect from sustainability going forward as a new buyer. If you're pursuing an SBA loan, there's significant monthly principal and interest payments that are due on your loan. So you need to understand from a cash flow perspective, can this business even support this SBA loan you're about to take out? That can be performed by a quality of earnings team, doing some sort of modeling and understanding the cash flow of the business to basically break down and show you, hey, here is what cash is available for your debt service at the end of each month. That gives you a clear view into, can this business support the SBA loan based on its historical history? So what are some benefits of effective due diligence? Really, it's ensuring a fair valuation of the business. So understanding what is the normalized earnings of a company. Due diligence looks to build trust between you as a buyer and seller. As a buyer, you have every right and should be asking very challenging questions to understand the business. You have, once granted your exclusivity period of 30, 60, or 90 days, you effectively have only a few months to understand a business that might have been operating for over 20 years. That's a significant lift. And in order to do that, you need to ask very challenging questions, which may be uncomfortable for the seller's team. The benefits of using a third-party provider is you get to establish a buffer where you as a buyer can maintain good rapport with the seller, but still get your questions answered. It's something to think about if you're thinking about doing due diligence on your own. But maintaining that level of trust and good rapport between buyer and seller is often the most important thing outside of valuation you can do as a buyer during due diligence. And then really it sets the foundation for a successful acquisition. If you're able to complete due diligence in an effective manner, you can set the foundation for a successful transition. And more importantly, if you still have that rapport, you can ensure the seller is going to have your best interest during your transition period as a new owner of the business. So what are some legal and operating due diligence risks? Things to think about. One is the contract review. Checking contracts, master service agreements, etc., for the change of control and termination clauses carefully. What do I mean by that? In instances of certain industries, government contracts in particular, or other large contracts, government or municipal in nature, there may be clauses where ownership changes trigger the opportunity to rebid the contract to a variety of vendors. You need to understand what the contracts mean when you're analyzing prospective companies. In the instance where a business might have a contract which has a clause that can reopen the bid to other vendors, you likely would use a stock sale rather than an asset sale. A stock sale, you effectively buy the shares of the company and the entity doesn't change. That can limit your exposure to some of these contract control clauses. That's just one example. Environmental liabilities is something that I've seen come up a lot recently. depending on the industry, ensuring you're in compliance with environmental codes um, limits your exposure to some of the risks that you may be fined by the township it's operating in, or need to have some restoration costs around it, is something else to think about, and I have seen frequently. And then kind of confirming ownership and the intellectual property of the asset you're looking to purchase. These are often things I see frequently, and things I want you to think about. So we spoke a lot about what is in that letter of intent, and I wanted to walk you through a real example of what that looks like, at least in some form. So this was a letter of intent for a landscaping company, which was 100% buyout, as noted here, acquire 100% of the membership interest for $6.75 million. That is what I spoke about is the purchase price. This does a good job in very clear language of here is the purchase price. It then begins to show, of that $6.75 million, what is that comprised of? It's going to be comprised of a few things. It's comprised of, at closing, the buyer will deliver to the seller a note for $750,000. This seller note is to be repaid at 8% interest over 10 years with a 2-year standby, 5-year balloon payment at year 5. That is a textbook definition of what a seller note is. If you're thinking from my initial points, this is still allowed by the SBA because it is 100% buyout. If you recall, the two changes were if you were doing, say, a 90% interest rather than 100, this seller note would not allow the 2-year standby. Additionally, it then proceeds to talk about, at closing, buyer will deliver to the seller $6 million in addition to the deposit and the note. The $6 million is effectively the cash at closing. So at the time of closing, at the end of the purchase agreement phase, the buyer is going to deliver $6 million. Likely the $6 million is going to be a combination of the buyer's cash or equity injection and the SBA bank cash. Those are kind of the mechanics of where this $6 million actually comes from. It also notes, at closing, buyer will enter into a minimum 1-year employment agreement with the principals of the seller, with compensation to be negotiated by both parties prior to closing. This is a high level agreement that the seller is going to stay on and work with the buyer for a 1-year period, and they'll be compensated accordingly. This is something that's helpful to include in just to gauge where the seller is at for the transition period. Some sellers might not have any interest in working with you post-close. Best practice is to at least get them on board for 3 to 6 months. In reality, based on how quickly you're able to integrate into the business, you might not need them to be around at all once you close on the business, but it's good to have in your letter of intent, and you can use it or not use it. So that's how these components work. Other areas to call out was in the top, it says $10,000 shall be delivered to the seller upon delivery of this letter of intent. So when they presented this letter of intent, they also gave in escrow $10,000 as a good faith deposit pending the closing of the transaction. This is something where sellers and brokers may ask for. I would caution a large escrow or deposit amount remitted. I've seen things like 50,000, 100,000. In my opinion, those are way too high, and it leaves you the exposure to not getting that escrow back for whatever reason, or having to litigate to receive that and back to you. In this case, $10,000 for a purchase price of almost $7 million is a nominal dollar amount, so it's okay. So when you submit, for example, this letter of intent we just viewed, it's very likely the seller is going to digest this with his team, and they may come back to you and negotiate. Rightfully so, this happens more often than not. They may negotiate on things like the purchase agreement. They may negotiate things like some of the terms of the business, the price, the post-close transition support. They might want to work in the business for only 6 months, or maybe they don't want to commit to anything in this letter of intent. The best practice is to just manage expectations accordingly. Avoid overpromising at any stage. If you want, for example, the business owner to stay on for a certain number of months, I would make it very clear you do, and here's why. Overpromising and not having clear communication often leads to disagreements. If you're going to have disagreements, it's often better to have them during the letter of intent phase rather than purchase agreement time, primarily because of the time and money you risk losing if this deal does break. So how do you maximize your acquisition success? Use the LOI as a roadmap. Guide your deal with structure, terms, and clear diligence. Take a proactive approach. Try to spot issues early to avoid surprises later. When you're conducting preliminary financial due diligence, taking that proactive approach to spot issues with the financials, things you don't like about the business or might be challenging for an SBA lender, is very helpful to avoid broken deal costs. All of the prep and planning around letter of intent is to make sure your letter of intent can be supported by a bank loan, and it's reasonable to assume you can make this deal all the way through closing. It's easier said than done, certainly, but taking that proactive approach and using a clear roadmap is often best practice. Strategic advantage, positioning yourself through rapport building with the owner, understanding their personal wants and needs. This all gives you the tools needed to close deals and work with great buyers and sellers. I've been doing transactions for over a decade. I've worked with hundreds of entrepreneurs and investors to buy small to medium-sized businesses. I will say, from my personal experience, those with good rapport and mutual respect for one another, more often than not, close deals. If buyers and sellers have significant issues or just a lack of trust, more often than not, these deals won't close for a variety of reasons. Primarily, the lack of trust is something that is challenging for sellers and buyers to get over. Because, rightfully so, sellers don't want to feel like the buyers are trying to pull one over. So for the buyers out there actively searching, being upfront and honest about why you want to buy the business, why you like the business, what works for you, understanding what works for them can set yourself apart to buy a great business and work with a exceptional legacy owner to ensure you're set up for success.